Okay, we will just start now, right now. Okay, right now we will always start with just a quick weekly update, just some short-term views on what has happened to the market and what will be happening soon. So anyway, we'll just start off with week 36. Okay, in some of the key events for last week, at least on the macro front first, as you know, the core PCE data, which is the inflation number which the Fed looks at, was close to 2%, and it's basically at the Fed's target. So in conclusion, what it just means is that it just reinforces the view that there will be 2 more rate hikes for the rest of this year. There were some better macro numbers overseas, the German IFO and the Chinese PMI data. So this also suggests that although global growth rates have peaked, globally things are still quite stable. The economic situation the growth is still there, just that the growth rates has peaked from a couple months ago. And also the recent data, as you can see, most of our key macro data, we will publish it every day. So anyway, you can see that the unemployment rate in the EU has actually back to the pre-global financial crisis lows. So it's not only the US that's enjoying good employment data, even the European Union is also enjoying that. In terms of Singapore-specific data, when you look at the last last week, there was some data on tourist numbers, some data on hospital, and both numbers were actually pretty weak for Singapore. Another thing would be just to note is that Apple will be announcing their on 12th September the new iPhone, the new lineup, probably the 3 new phones. So if for whatever reason there's a strong response to these new phones, then of course it will benefit these 2 stocks, Hype and Memtech. In terms of another news is the TPG. As you know, TPG in Australia will be announced on Thursday that it will be merging with Vodafone Hutchison. So there used to be almost 4 mobile operators in Australia. Now it boils down to 3. But for the Singapore mobile operations, as you know, TPG is going to be the 4th mobile operator. They will set up a separate company, and what it means is that the Vodafone Hutchison will not be part of the 4th Singapore mobile operator. So in a way that is positive in the sense that the 4th operator owned by TPG won't enjoy the balance sheet of Vodafone and Hutchison. Okay, in terms of our latest views, again, I think we've always said that banks is still favorable for us. One new thing is probably the strong Sing dollar. I think the CPI in Singapore is creeping up, and that is going to probably reinforce the need to probably tighten a bit more on the Singapore dollar. So that will be positive. And the SIBOR or interest rates in Singapore continues to creep up. Of course, REITs is also supportive. The strong Sing dollar is also supportive for the REITs. The other news is, of course, if some who did not catch it, is the rubber gloves. As in, we actually did highlight it in our previous month-end report. But anyway, there's a rule coming out in the US that there'll be a double donning of gloves. What this means is that in hospitals and labs in the US, you have to wear 2 gloves instead of 1. So obviously this is going to be positive. It's named as the USP 800 rule. Anyway, it's going to add another 6 billion of gloves, so that will be positive for the rubber glove industry. The 2 stocks that are listed, at least in Singapore, is UG Healthcare and Riverstone. In conclusion, for us, we are still defensive for the market in the near term, especially when there's an upcoming imposition of tariffs. As you can see at the bottom point on 6 September, Thursday, the US Trade Representative will announce their ruling on the tariffs, the 200 billion. So there could be another 25% tariff on 200 billion of Chinese imports. And then after that, you will know, after this public hearing, they will announce that. Then after the news, the sequencing will be, then the Chinese will announce. So you're probably going to get a bit of negative headlines in the near term. On 4th September, you're going to get the global PMIs, and then 7th is going to be the US wage. Okay. Anyway, this is just our weekly, just a short update on what has happened and what are the latest points for everyone to take note of. Okay, I will move on to this company specific, which is the results for Micromechanics. They announced their 4th quarter results. As you can see from the red box, The one that fell was actually the gross profit margins. Of course, gross profit margins are still attractive. It's still about 55%, but it just fell off from their high of 59. In terms of the positive, they announced a final dividend of 1 cent. There'll be a confusion. As you can see, there's a 6 cents here because that 6 cents include a 1 cent special, which they've been giving for the last few years. But anyway, in totality, they were paying a 10-cent dividend per year. So about roughly about 5% yield. And they've actually doubled their dividends over the past 4 years. The other positive is the US. US is a new business segment. And after 10 years of losses, we saw a turnaround for the US operations. This is good because this gives them a new runway of growth. As you know, for those who know, micromechanics is more on the back-end semiconductor, which is on the parts for the packaging and testing of semiconductors. In the negative, of course, as mentioned earlier, the gross margins actually slowed down, and this is the slowest in more than 3 years. And also revenue growth has also been starting to taper down in the fourth quarter. We still like this stock. Although semiconductor sales is going to slow down, we think most of the slowdown is going to be on the equipment. And for micromechanics, again, they're more dependent on the volume. Just a reminder, the demand for the products like the rubber tips, actually every 8 hours, the customer will actually reuse the rubber, will actually order a new set of rubber tips. So these are consumable items. So every day you need to actually replenish supply for their products. And another product like ejection needles, actually you need to supply every few days in a week. I think 2 or 3 days in a week. You need to reuse. You need to order new supply because the wear and tear, and you cannot afford any contamination. So that's why we like this stock because it's a consumable. That means the demand is relatively more recurrent. Okay, move on to the next slide. This is basically our target price. How we came up with the 17 times. As you can see, this is within the industry. There's totally no comparable. So we just take the whole back-end semiconductor supply chain. OSAT basically just a term for those companies that do the actual packaging, and it's like your stats ship pack that do the packaging and testing. So actually this whole segment, that's why it hasn't performed well. So the whole sector actually hasn't done particularly well. As you can see, these are the equipment makers. These are the back-end and packaging packaging and test equipment. So that sector has also have not done well, and of course that has also dragged. But as you can see, they stand out well for micromechanics because of their margins compared to the whole industry. It's almost double not almost, but maybe 50% higher than the industry margins. Also, their ROE is always a standout because it's always much higher than the industry. Okay. So anyway, this is a stock where if you still like semiconductors, but you don't want it to be so volatile, the thing micromechanics will be our pick. Okay, I will move on to the next results by meaning.
So moving on to HMI. So we maintain our buy call with an unchanged target price of 83 cents. And for the positive for this, these are full year results for HMI. Their patient volume and average bill size ramped up both hospitals' earnings for both Makota and also Regency. And foreign patient load grew faster than local patient load, which accounted for 24% of the total patients. And for outpatient, it was the main driver because inpatient remained relatively flat because of competition from cheaper Malaysian public healthcare, as well as a trend towards a shorter length of stay in patients. And then for day surgery, the cases continue to lift margins at both hospitals. Day surgery is gaining traction, and we see that the bed occupancy rate is trending downwards, and a higher average outpatient bill size is also seen. So total number of beds remains stable at 437. And then EBITDA margin also improved. And this is mainly driven by Regency's margin because Regency is newer than Makota, which is 25 years old, and has margin is also driven by effective cost management structures. And the negative this time round, finance costs increased 57.2% year on year. And this is mainly due to borrowings increasing by 32 million due to a 103 million mortgage loan taken in by the group for the StarMed acquisition in May this year, and offset by repayment of term loans. So even though we see a huge increase in finance costs for FY18, but we think that the group's higher leverage will be well contained by healthy operating cash flows as we have seen for the past few quarters. So for the outlook, we remain positive on the upgrading and expansion plans in Mahkota and Regency, and we expect these expansion plans to be on track to meet the growing demand in Malaysia. So for Mahkota, they have already completed the renovations for the Ward 9A and the pediatric rehabilitation, and their upgrading and refurbishing of older wards over the next 2 years are on track. For Regency, the new extension block will double the capacity, and the mid-term target is 380 beds, long-term target is extra 500 beds. So the construction expected to commence by end of this year, and the operations will expected to commence in 2021. So for StarMed, this is the acquisition completed in May 2018. So the group acquired 62.5% of this one-stop ambulatory care center in Singapore. It's located in Farrer Park and takes up 4 levels of the building. So the entire StarMed facility is fully renovated, fully fitted out and utilized, and they have already received licenses from Ministry of Health to operate. So we expect initial gestation startup losses from its operations to drag down margins for the next 2 to 3 years. So all in all, we maintain buy with an unchanged DCF derived target price of 83 cents. So next I'll pass on to Richard.
Hi, good morning, everyone. This is Richard speaking. Yeah, so 800 Super announced the results last week, and as you are aware, the price dropped by quite a large amount last week as well in reaction to the loss that was reported in the fourth quarter. We have upgraded the stock to buy, and with a lower target price of 103. The previous target price was 130. We also now forecast a dividend of 1.5 cents for this year. They'll give you a 2.3% yield based on last Friday's close of 64 cents. So as you can see, revenue for the full year was down 3.7%. This was due to completion of some contracts and renewal of contracts at more competitive prices. Operating expenses has increased and outpaced the decrease in revenue and exacerbated the decrease in revenue. So PATMI for the full year is down by about 47%. I'll talk about the positives first, then the negatives. So for positives wise, their new sludge treatment facility is already treating sludge and is expected to be fully operational by the end of this year. If you recall, this sludge treatment contract was awarded at 133 million for a period of 15.5 years. So this would give you an average of 8.6 million revenue going forward. So this facility has already started treating sludge in January. So the revenue recognition has not contributed yet for the recent quarter. The other thing is Pasir Ris Bedok public waste collection contract has also already commenced starting in June. You also start to see contribution in first quarter FY19. This contract should also see an average of about 26.4 million additional revenue each year. So for the negatives, there was a higher than expected manpower cost, and that was the key contributor to the earnings miss from our expectation. Take note that manpower cost is the largest cost component for the company. It's about 53% of operating expenses. The other thing is the balance sheet at the end of the year is weaker compared to last year, but this was expected. we already were forecasting the weaker balance sheet. This is mainly because of the higher capex for the new projects, and then they took on additional debt to fund all these capex. This year, the dividend also is lower and payout ratio is also lower. So last year, they had a 1 cent interim dividend and 3 cent final, but this year there's no interim, and this year final is only 1 cent. So for full year wise, this year is 1 cent, last year was 4 cents. Last year's payout ratio was 42%, but this year payout ratio is only 20%. So one of the reason for this obviously is the lower profit, but also the lower payout ratio is likely due to the capex requirements for the upcoming Pasir Ris Bedok public waste collection contract. So it's coming in stages. First is July, and then the next one is coming in November. They have already started for Pasir Ris and Tampines, and then November will be Bedok. The other thing is that they have already fully written off the goodwill from the acquisition of iWash Laundry. Take note that this goodwill is actually a small amount of total assets. It only contributed to 0.2% of total assets. Yeah, so for outlook wise, is currently positive. The 4Q loss is non-recurring, and it does not represent the future prospects. As mentioned earlier, this July they will start to recognize revenue for the sludge treatment facility and the Pasir Ris Bedok public waste collection contract. So we do not expect them to have any more report any more losses for subsequent quarters. On a full year basis, for FY19, we're expecting 19% increase in revenue and about 55% increase in PATMI from FY18. So this will be driven by these two projects, the sludge treatment facility and the public waste collection contract. So also take note that this year there will be certain transitional thing for these two projects as well. First of all, like I mentioned just now, the Pasir Ris Bedok contract is coming in stages. First is the Pasir Ris Tampines section, and then Bedok. So, and for the sludge facility, they are still ramping up production until December 2018. So that's why FY19 will be transitional, and FY20 will be more representative of a normalized business. So for FY20, we are estimating 8.18 cents EPS and 7.84 cents per share of free cash flow. So based on last Friday's close of 64 cents, 64 cents is actually about 8 times PE or 8 times free cash flow per share. Okay, now we move on to Teh Hong.
Thanks, Richard. Good morning, everyone. I have just one update from last week from CapitaLand Mall Trust, where they acquired Westgate from their parent CapitaLand. So the summary of the transaction is that the CMT will acquire the remaining 70% stake in Westgate. We remember they already own the first 30%. So the valuation of the mall at the 1.1 billion is actually at an entry yield of 4.3%. And this 4.3% is actually at a yield comparable with what Jurong Point did last year. And some of the stats for the mall is that the latest committed occupancy is already 98%. And there is a 99-year lease from 2011. So with occupancy at 98%, you'll see that this entry yield of 4.3% will be, if you are intending to depend on higher occupancy to boost these earnings, that will be already pretty capped because it's already pretty much at full occupancy. So going forward, your kicker for earnings would only be coming from organic growth in terms of the existing tenants when they re-sign their expiring contracts, which in short means the depending on the rental reversions going forward. This also means the capital recycling from the proceeds of the Sembawang Shopping Centre sale has been recycled into a newer asset. This is on the surface, it looks like it is a higher yielding asset, but also remember that Sembawang Shopping Centre was on a freehold tenure versus the 99-year for Westgate. So the implication for the parent side of things is that this will translate to a 99 million valuation gain for CapitaLand, and that translates to a 2 cents increase in NAV for the parent group. So what do we think about the transaction is that if talking about this valuation gain of 99 million, this 99 million is a 14% increase from the last valuation just 2 months ago at the end of June, when the REIT reported its second quarter results. And the entry yield of 4.3% is also lower than the portfolio NPI yield of 5.8%. By our estimates, we think that the acquisition will only be accretive if it were to be heavily funded by debt, which means to say if they fund it with a funding capital structure of more than 70% debt, 30% equity, because we know that debt will be cheaper than equity. And going by the average cost of debt for CMT now at about 3.1, 3.2%. If you use more debt, then you will have the yield spread from the 4.3% entry yield versus your cost of capital of 3.1%. So we estimate that if they were to fund it by more than 70% debt, then only will it be accretive. The outlook is that depending on the funding capital structure, which is not decided yet, and also is subject to approval at the EGM, if we assume a minimum 70% debt funded acquisition, it will pretty much point to a neutral in terms of the how accretive it is to the DPU. If they were to fund it using 100% debt, then that could potentially lead to a 2 cents increase in our target price. So for now, we maintain our target price and a neutral call on CMT, and our target price translates to an FY18 yield of 5.6% and a price NAV of 1.03. Okay, with that, I'll pass it on to Guangzhi for the Geo Energy results.
Okay, thanks, Dong. It's Guangzhi here. So next I will talk about Geo Energy's second Q results update. So we maintain our buy call with a lower target price of 34 cents. And the second Q performance was a bit disappointing, mainly due to the higher mining costs. So you can see the results here, the top line growth by 41%. However, the bottom line dropped a little bit because the cash cost increased substantially. So the positives are still the growth in production and healthy coal prices. So during the second Q, the ICI 4002 gut prices rose by 11%. And also the production target, the sales target is still on track. According to the management, the SDJ mine is expected to deliver 8 million tons of coal sales. And for TBR mine, which is the new mine, to be estimated to deliver 2 to 3 million tons. So you can see the breakdowns of the top line here. So the negatives, as I mentioned before, is the temporary increase in cash costs. As we knew that the TBR mine has commenced operation in May, so it is expected that the next 2 quarters, TBR mine will generate some revenues. However, according to the IQPR report, the TBR mine's strip ratio for FY18 is around 7.1, which is very high. And subsequently, it will decrease once the group remove the topsoil, the dirt on the coal. So next year, the strip ratio will decrease to 3.9. So the production weighted average strip ratio for the whole group is expected to be around 4 in this year, and next year it will drop to 3.5. So accordingly, the average cash cost for the group in FY18 is expected to be $30 per ton, compared to last year's $28 per ton. So the outlook for Geo Energy is still bright. We think that the ramp up of coal production will continue at least until FY18. So in the near term, there are 2 catalysts that we look forward to. One is the potential acquisition. According to the management, the potential target will be a high CV coal mine. That means the high CV coal mines will enable the group to improve the top line. And also the new offtake agreement for TBR mine. The management shed some light on this new offtake agreement that the terms will be better than last year's for SDJ. So last year, the SDJ offtake was around $40 million and securing 7.8 million tons. So this is the update for Geo Energy. Next, I'll move on to Paul.
Hi, everyone. This is Paul here. Just the initial coverage on ayondo. If you read at the bottom, just a disclaimer. This is under the SGX. This report was published under the SGX Stock Facts Research Program. So the research department has received monetary compensation for the production of this report. Okay, we will move on to. Okay, so Anil, what does ayondo do? Ayondo, basically, they service 2 types of customers. There's a B2C customer, your typical client that trades on their own on a DIY basis, or there's also clients that want to replicate the portfolio of other truck traders, and we call that social trading. The other type of customers that ayondo has is B2B customers, which is basically your traditional online or mobile brokers that want to gain access to ayondo's CFD platform, trading platform. You call it white labeling, of course. The products, all products that ayondo sells, these are all CFDs. The customers, as much as 60 countries, but predominantly most of them are from Europe. Germany is their core. Germany and UK is the core market where they have licenses. The products they actually sell include stocks, indices, commodities, forex, and also cryptocurrencies. It was listed in March at 26 cents. Our target is 22. Okay, and how ayondo makes money? Basically, they make money on the CFD spreads. For every transaction that a client makes, they are actually on the opposite side of the transaction. So once you are on the opposite side of the transactions, there are 3 ways that there are 3 options they have on this position. You can either hedge it out to another liquidity provider or to another bank. They can actually warehouse it into their own books, and of course they can also square it off with an opposing trade if another customer comes in at the same time on the other side of the trade. Okay, in terms of the revenue, like we mentioned earlier, they have two types. One is a B2C and the other is B2B. In terms of competitors, if you check most of the reports out there, there's basically only three. There are many social trading sites, but the three most notable are actually eToro from that trades customers mainly in the US and even China. There's one, the eToro from Europe and also US. There's one from the US, only US, which is Zulu Trade and of course ayondo. So globally, these are the three most notable social trading sites. In terms of the cost structure, you will see a lot of huge rebates on the P&L, but that's mainly comes from their B2B trades because all the transactions that flow into their trading engine, they will farm back out some of the rebates. Of course, there are staff costs and marketing costs. Okay, in terms of our investment thesis, basically, again, the thesis is behind their platform business. Because as you know, platform has superior economics. The good thing about platform business is that you can erect very high barriers and you can differentiate it through the network effect. So what happens is that once you have more followers, they will actually attract the top traders to their platform. And once this happens, you'll get this virtual cycle of more followers and more traders, and that will differentiate the product and erect barriers to any competitor. The other investment thesis will be the fast growth underway. We think there are three main growth drivers. Firstly, it will be new geographies. They plan to move into other parts of Europe, Spain, the Benelux and Scandinavian countries. And also new products. They will probably create a simplified portfolio of the other top traders, and they will also may allow small portfolio managers that are subscale to actually release their track record and so that they can build a track record off their platforms and sell their asset management solution. And the other is, of course, they also could accept crypto as a form of payment. Okay, the other growth driver will be there will be more partners, but I guess the most important for them is to get a commercial bank as a partner. In the prospectus, it was mentioned that they have been in talks to work with a commercial bank that will use their social trading network. That will kind of give credibility to the platform and also will provide them a large swath of customers. The third part of the investment thesis is that this could be another emerging alternative asset management platform because the fees that you pay on this is transparent. And you can link it to the returns because the returns are virtually monitored real time. Because it's real time, number two, you get better client engagement and experience rather than getting the results of your fund or investments at the month end. And the other part is that you get bespoke solutions because each top trader will have their respective risk profile, types of products they trade, and so forth. So you can actually customize it to wherever you want, and also you can access to a more underserved market because to come into the platform you need a minimum of Euro 2,000. Okay, just the risk factors. Of course, there are multiple risk factors for this. There's a heavy reliance on this customer called Bucks, which is a mobile trading platform. Of course, when you take on the other part is the trading book risk because they are a counterparty to all trades, and then sometimes the risks are actually on their books. And the other part is the customer due diligence. What we mean is that when they take on some of these B2B customers, they actually do due diligence on these B2B partners, clients. Of course, there's always competition in this business, and that's why it's important for them to gain scale. Brexit is the other risk because they have a license in the UK, and of course, if there's a so-called hard Brexit, there's no longer any passporting rights. Passporting rights basically means they're unable to sell into other European countries. That means the license is not valid in other European countries. And the final and probably more important risk factor is the cash burn rate. In the first half, the operating cash flow was a negative 5 million, and cash in hand is only about 3.2 million. Okay, in terms of valuations, it's very hard to value this stock because there's no other comparable. But what we did was we took price to sales across all the various fintechs out in the marketplace, excluding PayPal, of course. So in the market, if you can see on the right-hand side of the column, the second right-hand column, the price to sales of most of these fintechs are almost as high as 14 times. So we just try to apply a large discount, 50%, and that's what we get on our target price, which is 22 times. This is just like one last slide. This basically shows the fintech universe, the players out there. As you can see, when you talk about fintech, there are basically 4 large parts. There's the financing, payments, and asset management. So ayondo is on the asset management part under social trading. The big parts of fintech is, of course, on the payments segment, and also on a lot of this crowd lending, and on some of this a lot of them is from the US part, the Lending Tree Lending Club. Okay, thanks. That's it for us. Any questions, please? Yeah, we see a few questions. You give us some time to reply to them. Thank you.
Hi, this is Richard speaking. Yeah, there are some questions on 800 Super, so I'll go through them now. So the first one is about how do you see its performance in 3 years' time, and is it right that the company can only grow organically? I think let's just look at 2 years ahead first. I think that 2 years will be quite fair outlook for a normalized state, as I have mentioned just now, because these new projects are still going through transition during this current FY. So you can check out our report for our report, and you can see what's the forecast for FY20. And then for the second question about is it right that the company can only grow organically? That's not true, because they can do M&A, and that will be inorganic growth. And then we have another question, quite a good question. Is asking about the waste to energy plant. The question is, the waste to energy plant has been running for a quarter, but there seem to be no saving derived from the plant, and management did not talk about it. Yeah, okay, that is a very good question. So if you recall, the main purpose of the waste to energy plant, first of all, let me remind you what that waste to energy plant does. So it's a biomass waste to energy plant. It will burn horticultural waste and then convert that into convert it into electricity. So that's what the waste to energy biomass plant will do. And then the purpose of it is it will supply electricity to the adjacent vehicle depot and the sludge treatment facility that's adjacent as well. So as you know, the sludge facility is not running 100%. So that's why the waste to energy plant is also not running 100%. It doesn't make sense for them to keep on burning the horticultural waste. They'll be wasting the steam away, and the electricity will not be used. So that's what's going on with the waste to energy biomass plant. Its utilization rate will go up together with the utilization of the sludge treatment facility. Regarding that, there seems to be no savings derived from the plant. Actually, is very difficult to say. It's not possible to see that in the numbers, because don't forget, there are several other things that have come in to the financial statements. That is the eyewash laundry business and the plastic recycling business in Batam. So you can, so with these two additional businesses, it will be difficult to isolate the effect from this biomass waste to energy plant. Hope that gives a detailed enough answer to that question. Okay, there's another question about the net current liability position. What do I think about its net current liability position? It's just a temporary thing. If you look at our forecast, by the end of this year, it'll be a net current asset position already.
So it's Meaning speaking here. So the question for the top healthcare pick would be HMI. So mainly HMI is driven by insurance, aging, and medical tourism. So as you can see, Singapore's medical tourism is slowing down. So in that area, SOG, QNM, and also Raffles may not be able to see growth as well as HMI. So for Malaysia, the upgrading of the Malacca International Airport will also see a higher influx of foreign patient load. And we can see from this quarter, the foreign patient load is already faster. The growth in foreign patient load is already faster than the local ones. And for the public and healthcare sector, there are initiatives from the government also to improve the infrastructure and also connectivity. So this shows that there's still much more space for growth in Malaysia with all these initiatives. And also the insurance take-up rate is also increasing. So there will be a higher translation of patients with insurance into being more willing to pay for private healthcare. And also they have very cost competitive pricing. So within Malacca and Johor itself, there are hospitals that are building up that will be future competitors. But within the next few years, HMI would have the largest pie of the market share. So over the next few years, HMI will definitely be the one who will be able to see more growth. And those hospitals that are still building, they take time to expand and to get the respective licenses and also accreditations to be like HMI. So they have also established foothold in Malaysia itself, and it's also they have a reputation of being the safest and most accredited hospitals in Malaysia. So for the question of growth hardly moving, this one, the catalyst, it will be what I've said before. It will be insurance, aging population, and medical tourism.
Hi guys, De Hong here again. There are a few questions on CMT. I will address them one by one. Some of the questions include, would CMT need to raise new equity? And what is the cap rate for Westgate at the previous valuation? And then would this transaction lead to upward revisions in values of retail space? So as mentioned, if CMT were to check up to take over the acquisition using 100% debt, their gearing will be up to 36%. But that being said, I don't think they will use 100% debt, so it's probably going to be somewhere in between 70 to 100. So that will bring their gearing to probably around the 34, slightly below 35% level. I think that is the level that management has expressed comfort at this level before. And I think if I look across all the CapitaLand family of REITs, they also hardly trade above 35% for a sustained period of time. So I think if it were to land slightly below 35, I think that would still be at a comfortable level for management. Then in terms of, I think further acquisitions in the near term, I think this Westgate is the lowest hanging fruit for them. And management has expressed that they are not ready to go overseas. And also next year they have the catalyst from the completion of Funan. So I think near term they already will have some catalyst from this acquisition, and then next year Funan as well. And so for this acquisition, the implied valuation of the mall is 14% higher, despite the last valuation just being done about 2 months ago at the end of June. So the cap rates at the end of June for CMT for their suburban malls are in the 4.6 to 4.7% range. So you have Tampines Mall about 4.7, Bedok Mall 4.6, Westgate previously was 4.6, and then now they acquired it at 4.3. So it is also likely that, because as we all know, the valuers, each time they review, they also take into account all these physical transactions. So now that Westgate is taken over at 4.3, there can, as you correctly pointed out, there can be potential compressions in cap rates in the retail space going forward again. And there is also another question on why would it only be accretive if more debt is taken, and how how would the funding capital structure affect whether it's accretive? So as we all know, the cost of debt now for CMT is about 3.1, 3.2%. The entry yield is 4.3%, and if you look at the cost of equity now, as we all know, cost of debt will be cheaper than cost of equity. So just using their yield as a gauge now, about low fives, mid 5%. If you were to take on more debt, let's say 100% debt, that means your cost of capital for the transaction will be about 3.1%. And if you have an entry yield of 4.3%, that means you have a good spread over your cost of capital. But then if you take on 50% debt and 50% equity, which can come in the form of rights issue or private placement, then you have 50% on a cost of capital of 3.1%, and the other 50% at a higher cost. Let's say if you issue private placement, and then your current yield is about 5.2%. Then your cost of capital, of course, that is just a simplistic way of looking at cost of equity. So if you were to take on less debt, which is cheaper than equity, then your cost of capital for that acquisition will go up, which means your entry yield, the rental yield that you're getting over your cost of capital narrows. So that will mean that it will become less accretive.
Hi, there is a question asking about Geo Energy's cash costs and the comparison with first half last year. So you can see the table here. The cash costs as of first half of this year was $31.3 per ton. So compared with last year's $25.7 per ton, up around 21.5%. So the full year cash cost is expected to be slightly above $30 per ton.
Okay. Hi, this is Paul here. Just on your ayondo question, thank you for the question. I'll just read it out. ayondo has fully used up the IPO proceeds and the cash flow is still negative. The 50% discount versus peers seems too little, or the share price is too much undervalued in your sense. Thank you. Okay. And the other question is also something related to the 50% discount versus peers seems too little. Yeah, I think, yeah, thank you for the question. When we put the discount, there's no hard science to it. Why 50 and not 45 or 46? Again, it's very difficult. We also grapple with the problem of what is the actual discount. But we just thought that 50% discount would be a number that we would be comfortable. Actually, it's more than 50 because it's about 6 times compared to 15. But anyway, but as you would know, if we hit 6 times and then if we push to 5 times, the swing can be, mathematically as much as 20%. So this is very sensitive. We just applied a 50%. There was no rough number-wise 60 or 70. We just thought that it was kind of applicable because we're already taking quite a huge discount to the whole sector. But there was no real hard science to coming up with what is the right number. And in terms of the question on fully use of the IPO proceeds, you are right, because most of the proceeds was used to pay off the convertible bonds by the pre-IPO investor. So I think that in a way kind of leave them with the need to, with a bit of a cash shortfall with only 3 million. And if you look at our report at the back on the operating cash flow, you can see that there's actually a negative cash in hand. So there is a challenge that the company will have to take care of. Yeah. In terms of, the other question is on ayondo. What is the rationale for the buy rating when it's a high risk cash burn rate, high trading book risk, high competition? Yeah, because this is a high risk bet. In conclusion, that's why we put all the risk factors there. I think although they're listed, the finances is almost more like a startup phase. When you're in a startup phase, the cash requirements is going to be high. I do not disagree that this is, like I said, it's a high risk. That's why you put risk factors there and high. But because this is a startup high tech company, that's why you're going to be. That's why this is a high risk investment proposition. Yeah. Thanks.
Hi, this is Richard again. So there's a question about when is 800 Super X date. They have not announced the X date yet, but if you go and look back at history, the X date usually happens either at the end of October or early November. The last 2 days or the first 2 days, last 2 days of October or the first 2 days of November. That's what has been happening in the last few years. Yeah. So, okay, we do not see any more questions. So thank you for attending and see you again next week.